Hey everyone, welcome to our deep dive today. We're going to be tackling something that might be brand new for some of you. Personal finance, especially if you're a working professional here in India. And maybe you haven't had a lot of experience with managing money. Or maybe it's just always seemed kind of overwhelming.
Yeah, it's actually way more common than people think. A lot of professionals, no matter what their background is, they just haven't had much exposure to personal finance.
Right. It can feel like this whole other world.
Yeah.
But that's what we're here for today. We're going to break it all down and make it super accessible. So no matter where you're starting from, you can gain some solid knowledge and start taking control of your money. And our guide for this deep dive is Monica Helan's book, Let's Talk Money.
Great book.
Yeah, I really like how she explains things. It's very clear and straightforward, even if you're like, finance what?
Totally. She breaks down these complex ideas into steps anyone can understand.
Okay, so Helan uses this image of a money box to represent your financial life. I found that really helpful.
Oh, yeah, I love that analogy.
So it's basically this container where your income comes in, like your salary.
Right.
And then your expenses flow out, like rent, bills, all that stuff.
Exactly. And the key is, managing that flow so you're not just constantly emptying the box.
Right. Makes sense.
Right.
So how do we actually do that? How do we manage this money box?
Well, Helan recommends this system called the 3-account system.
Yeah.
And basically, you divide your money into 3 separate accounts. You've got your income account, your spend it account, and your invested account.
Okay, so my salary goes into the income account first.
Right.
And then from there, I decide how much goes to spend it and how much goes to invest it.
Exactly. It's all about being intentional with your money.
Yeah, like giving it a clear path instead of just, letting it all kind of slosh around.
Exactly. And this way, you're less likely to overspend because you're making conscious choices about where your money goes.
Okay, so let's talk about the spend it account. I'll admit, this is the one I struggle with the most.
Yeah.
Are there any guidelines or rules of thumb for this account?
Yeah, definitely. Helan suggests aiming for certain spending ratios. So for your essential living expenses like rent, groceries, utilities, that should be about 45 to 50% of your income.
Okay.
Then for any EMIs you might have, like for a loan, that should be around 25 to 30%.
Okay, so that leaves 20-ish% for savings and investments.
Ideally, yes. Yeah. At least 15 to 20%.
Okay. But does that mean I need to track every single rupee I spend? That just seems so overwhelming.
Tracking every single expense can be a bit much, and Helan even says that herself. It's more about becoming aware of your spending patterns. So maybe try a budgeting app for a couple of months, or just jot down your major expenses in a notebook. Whatever works for you.
So it's not about being perfect. It's about getting a better sense where my money is going.
Exactly. You might be surprised by what you find.
Yeah, like those daily coffees that add up way more than you think.
Exactly. Little things can make a big difference.
Okay, so we're getting a handle on our spending. What's next in this personal finance journey?
Even with the best money box system in place, life throws curveballs. Sometimes unexpected things happen, and that's why Helan emphasizes the importance of another essential element, the emergency fund.
Okay, an emergency fund. Tell me more, because emergencies are definitely not fun.
No, they're not, but think of an emergency fund as your financial safety net. It's there to protect you from those unexpected events that life throws your way, like a sudden job loss or a medical emergency or, your car breaking down.
Yeah, those unexpected expenses that always seem to pop up at the worst possible time.
Exactly. And having an emergency fund prevents these situations from completely derailing your financial progress.
So it's like a separate savings account specifically for those just-in-case moments.
Exactly. Helan recommends aiming for 6 months' worth of living expenses in your emergency fund.
6 months' worth. Okay, that's a pretty hefty chunk of change.
I know it might sound like a lot, but remember, you don't have to build it overnight.
Yeah, I was going to say that.
Start small. Set a monthly savings target and gradually build up your emergency fund.
All right, so even if it's, $100 a month or whatever I can afford, just start putting something aside.
Exactly.
Consistency is key.
Okay. This emergency fund idea is making a lot of sense. It's like having that peace of mind, knowing that I can handle those unexpected expenses without having to, dip into my other savings. Or worse, go into debt.
Exactly. It gives you a buffer, a cushion to fall back on.
I like cushions.
Oh, wait.
All right, so we've got our money box set up. We're diligently building our emergency fund. What's next on our personal finance checklist?
And speaking of protection, Helan also stresses the importance of insurance. It might not be the most exciting topic.
It's not the most glamorous topic, for sure.
No, but it's absolutely crucial for safeguarding your financial well-being. Okay, so insurance, I know it's important, but to be honest, it always feels a little bit like a black hole to me, like money just disappearing.
I understand that feeling, but you have to think of insurance as a financial shield. It's
Yeah.
there to protect you from potentially catastrophic financial losses.
Okay, a shield. I like that.
And Helen focuses on two key types of insurance: health insurance and term life insurance.
Right, health insurance. That makes sense, especially if I, break a leg while trying to do some crazy skateboard trick.
Exactly. Health insurance helps cover those unexpected medical expenses, and it can really save you from a huge financial burden.
Yeah, for sure. And she also recommends looking into a top-up plan to supplement your existing coverage, right?
Yes, a top-up plan can provide additional coverage on top of your basic health insurance policy.
So it's like an extra layer of protection for those just-in-case scenarios.
Exactly.
All right, got it. And what about term life insurance? I'm young, I'm single, I don't have any dependents. Why do I need that?
Well, term life insurance is particularly important if you have people who rely on your income, like a spouse or children.
Okay, that makes sense. So if something were to happen to me, they would be financially protected?
Exactly. It provides a safety net for your loved ones.
Right, so even though I don't need it right now, it's something to keep in mind for the future.
Exactly. And, Helen actually shares a story in her book about someone named Kanchan who was unfortunately misled into buying an unsuitable insurance product, and it really highlights the importance of understanding what you're buying.
Oh yeah, definitely don't just blindly sign on the dotted line.
Exactly. Do your research, ask questions, and make sure the insurance policy aligns with your needs and your budget.
So shop around, compare different policies, and make an informed decision.
Exactly.
So even if my company provides health insurance, it's still a good idea to have my own personal plan as well.
Yeah, it's definitely worth considering because employer plans can have limitations. And Helen also points out that getting health insurance later in life can be tricky, especially if you develop any pre-existing conditions.
Right. That makes sense.
Yeah.
Now, Helen also talks about certain insurance products to avoid,
Yeah.
like endowment plans, right?
Right. She calls them financial traps disguised as investments. They mix insurance and investment in a way that's often not beneficial. Instead, she recommends a simple term plan. Think of it like choosing a clean, efficient code library. It does exactly what it needs to without any unnecessary bloat.
Okay, so we've got the moneybox framework. We've got our separate accounts for cash flow. Our emergency fund is the backup server. The right insurance is preventative maintenance. What's the next step in building our financial infrastructure?
Now we can start thinking about building long-term wealth through investments.
Ooh, now things are getting interesting. This is where it gets a little intimidating for me.
I know it can seem overwhelming, but remember, Helen emphasizes understanding the basics and choosing investments that align with your goals and risk tolerance.
Okay, so it's like building a house. We need a strong foundation before we can start decorating.
Exactly.
All right, so we've got spending, saving, insurance, all that good stuff down. But now let's talk about building that strong foundation for investments. Where do we even start?
Well, Helen talks about these different building blocks in the investment world called asset classes. Kind of like, how you need different food groups for a balanced meal?
Okay, I like that analogy.
Sure.
So what are the main food groups we need to know about?
Well, let's start with debt. Debt is basically lending money, like giving a loan to a friend or even to the government or a company. And in return, they promise to pay you back with interest.
So it's kind of like putting money in a fixed deposit.
Exactly. Fixed deposits, bonds, those are all examples of debt. You're lending your money and getting a fixed rate of interest in return. It's a relatively safe option, especially if you're looking for stability.
Okay, so debt is good for stability. Got it. But what if I'm looking for something with a bit more growth potential?
Yeah.
Something that could really help my money multiply.
Well, that's where equity comes in. With equity, instead of lending money, you're actually buying a piece of a company. You're buying their shares or stocks.
So I become like a part owner.
Exactly. And your returns are directly tied to how well the company performs. If their profits go up, the value of your shares also goes up.
Okay, that sounds exciting, but also a bit riskier than debt, right?
It is. Equity investments can be more volatile, so their value can go up and down more dramatically than debt. But over the long term, equity has the potential to deliver much higher returns.
So it's a bit of a trade-off. Higher risk, higher potential reward.
These are the building blocks of your investment portfolio. Helen uses a car analogy to explain this. Debt, she says, is like reliable public transport, gets you from point A to B, but not very exciting.
Okay.
Equity, on the other hand, is like a fast sports car. Potential for high growth, but with some added risk.
Yeah.
And finally, real assets like gold and real estate are like classic cars. Valuable, but require a lot of upkeep.
I love that analogy. That makes things much easier to grasp.
Okay.
So let's start with debt. What are some common examples of debt instruments that someone like me would encounter?
So think about fixed deposits, or FDs, and the Public Provident Fund, or PPF. They offer guaranteed returns, like a stable API.
Yeah, but the returns are relatively low. You're essentially lending money to the government or a financial institution for a fixed interest rate.
Okay, that's clear. But what about gold and real estate? Those have been traditional favorites, particularly in India. I've heard a lot of get-rich-quick stories, especially about real estate.
Well, Helen challenges these traditional biases. She says gold, while a hedge against inflation, doesn't generate income and often comes with high transaction costs. Imagine paying a hefty fee every time you run a simple query on a database.
Yeah.
Not very efficient.
So gold is like that legacy system that everyone wants to replace, but it's still hanging around. What about real estate? Is it really a bad investment?
Well, she uses a cautionary tale about someone who bought a flat in Gurgaon and ended up in a debt trap.
Oh.
She emphasizes that real estate can be illiquid, meaning it's hard to sell quickly, and often comes with hidden costs. Think about it like a complex software project with unexpected bugs and delays.
Right.
It might not deliver the returns you were hoping for.
Yeah, exactly.
Now, let's talk about the stock market. That can seem like this really mysterious and kind of scary place, especially for someone like me who's just starting out.
I know it can seem that way, but it's not about gambling or luck, as some people might think. It's really about understanding how companies perform and how the market values them.
Yeah, but I've heard people say you need to be lucky to make money with the stock market. Is there any truth to that?
Well, not really. Helen uses this example of the Sensex, which is an index of 30 of the most prominent companies listed on the Bombay Stock Exchange.
Okay, so the Sensex gives us a snapshot of how the overall market is doing.
Exactly. It's a good indicator of the market's health. And Helen presents some data that's pretty interesting. She shows that over the long term, the Sensex has consistently delivered good returns, even if you consider the worst case entry points.
So even if I invested at the absolute worst possible time, historically speaking, I would have likely made money in the long run.
Right. The key is long-term investing and something called the power of compounding, which we can talk about a bit later. But first, let's talk about a more approachable way to get started with investing in the stock market, and that's through mutual funds.
Mutual funds. Okay, I've heard of those, but I'm not entirely sure how they work. Can you explain it like I'm 5?
She compares mutual funds to a well-curated thali.
A thali, okay. I'm intrigued.
So think about it. A good thali has a balance of flavors and textures, right? You've got your dal, your veggies, your rice, your roti, maybe a little something sweet.
Yeah, I love a good thali.
And each dish plays a role in creating a satisfying and well-rounded meal. And a mutual fund is kind of similar. It pools money from multiple investors and uses that pool to invest in a diverse mix of assets like stocks, bonds, even gold.
So instead of putting all my eggs in one basket with just buying one stock, I'm spreading my investment across different areas.
Exactly. That's called diversification. And it's one of the key benefits of mutual funds, especially for beginners, because it helps manage risk. If one investment isn't performing well, others can help balance it out.
Okay, that makes sense.
Yeah.
So it's like not having all your money riding on, one horse in the race. You've got multiple horses running.
Exactly. You've got a whole stable of horses.
I like that analogy. But if it's a pool of money from different people who's making the decisions about where to invest, I'm not exactly a financial whiz myself.
That's where professional fund managers come in. These are people who literally do this for a living. They research, they analyze, and they make investment decisions on behalf of everyone who's invested in the fund.
So it's like having a personal finance expert on my team, even though I can't afford to hire one.
Exactly. They're working for you indirectly through the mutual fund.
Okay, that's reassuring. But how do I know that this fund manager is, actually good at their job and making smart choices with my money?
That's a great question, and that's why it's super important to do your research before investing in any mutual fund. You want to look for funds that have a solid track record and a fund manager with a proven history of success.
Or so don't just pick a random mutual fund based on, a catchy name or something like that.
Exactly. Look at their past performance, their investment strategy, and make sure it aligns with your own risk tolerance and financial goals.
Got it. So do your due diligence before you hand over your hard-earned cash.
Absolutely. All right. So now that you have a basic understanding of what mutual fund is, let's talk about the different types of mutual funds, because there are many different flavors to choose from.
Okay. Flavors like, chocolate chip cookie dough versus mint chocolate chip.
Kind of like that. You'll often hear terms like debt funds and equity funds, and these are like the main categories of mutual funds.
Right. So what's the difference between a debt fund and an equity fund?
Well, think of it this way. Debt funds are like playing defense, and equity funds are like playing offense.
Okay, I like sports analogies. Keep going.
So debt funds, they primarily invest in fixed income securities like bonds, which are generally considered less risky than stocks.
Less risky. Okay, so if I'm like really risk averse, a debt fund might be a good option.
It could be. Yeah, they offer more predictable returns, but maybe not as much growth potential as equity funds.
Okay, so lower risk, lower potential reward.
Yeah, that's a good way to think about it.
All right, what about equity funds? Those sound a little bit more exciting.
They can be. Yeah, equity funds invest in stocks which have the potential for much higher returns, but they also come with greater volatility.
Volatility, so like a roller coaster ride.
Exactly. There will be ups and downs along the way, but if you're investing for the long term, those ups and downs tend to even out over time.
All right, so if I'm young and saving for retirement, for example, I might be more comfortable with an equity fund.
It could be a good option. Yeah, but again, risk tolerance is personal. Some people are perfectly comfortable with a more aggressive approach, while others prefer to play it safe.
Right, it's all about finding what aligns with your goals and your comfort level.
Exactly.
So debt funds are like the slow and steady tortoise, and equity funds are more like the hare, with the potential for a faster pace, but maybe a few more bumps along the way.
That's a great analogy.
I'm full of them today.
But it's not quite as simple as just choosing between debt and equity. There are also different types of funds within those categories, like you might hear about large cap funds, mid cap funds, sector funds, and so on.
Whoa, hold on a second. It's getting a little complicated again.
Don't worry, it's not as overwhelming as it sounds. These subcategories simply help investors further refine their investment strategy based on things like company size, industry, or investment style.
Okay, so if I want to invest specifically in, technology companies or healthcare companies or something like that, there's a mutual fund for that.
Most likely, yes. There are funds that focus on specific sectors or industries.
Interesting. So I can choose a fund based on what kind of companies I believe in or what level of risk I'm willing to take.
Exactly. And that's where doing your research comes in, reading about different fund managers, their strategies, and the types of companies they invest in.
Right. So it's not just about choosing debt or equity. It's about understanding the nuances within those categories.
Precisely. And there's one more important distinction within the mutual fund world, active versus passive funds.
Okay, active versus passive. This sounds like we're talking about, exercise routines or something.
Not quite. But active funds are managed by those fund managers we talked about earlier. Remember, they're actively researching, analyzing, and making decisions about what to buy and sell to try and beat the market.
So they're like the captain steering the ship, trying to navigate the choppy waters and get me to my destination safely.
Exactly. They're using their expertise to try and generate the best possible returns.
Okay, so if I invest in an active fund, I'm basically trusting the fund manager to make smart choices with my money.
That's right. But active management comes at a cost. You'll typically pay higher fees for active funds because you're paying for that expertise.
Makes sense. So higher potential reward, but also higher fees.
Yeah, that's the trade-off. What about passive funds? Are they like the set it and forget it option?
Tell me more.
So passive funds, often called index funds or ETFs, they simply track a specific market index, like the Sensex. Have you heard of the Sensex?
Yeah, I think so. Isn't that like the Indian stock market?
It is. It's one of the major stock market indices in India. And a passive fund that tracks the Sensex will basically mirror its performance.
Oh, okay. So if the Sensex goes up, my passive fund goes up too.
Generally, yes. And because they're not actively managed, passive funds tend to have lower fees.
Oh, that's good. Lower fees are always a plus.
Right. So they're a popular choice for investors who want a simple, low-cost way to diversify their investments and track the market.
Okay, I'm starting to see the pros and cons of each approach. Active funds have the potential to outperform the market, but come with higher fees. Passive funds are lower cost, but might not deliver those, stellar returns.
Exactly. It really boils down to your investment philosophy and risk tolerance. Do you want to try and beat the market, or are you happy with matching the market's performance?
I think I need to think about that a little bit more, but this whole active versus passive thing is starting to make sense now.
That's great to hear. But before you rush off to invest in the first mutual fund, you see there are a few key metrics you need to understand to make sure you're choosing the right fund for you.
All right, key metrics. Let's hear them. I'm ready to become a mutual fund expert.
Well, one of the first things to look at is the expense ratio. This tells you how much the fund charges for managing your money expressed as a percentage of your investment.
So it's like the commission they take for doing all the research and buying and selling.
Exactly. And naturally, you want to look for funds with lower expense ratios because those fees can eat into your returns over time.
The lower the fees, the better.
Makes sense, right?
Yes, totally. What else should I be paying attention to?
Another crucial metric is the NAV or net asset value. Think of this as the market price of one unit of the mutual fund.
Okay, 1 unit.
It fluctuates daily based on how the underlying investments are performing.
So if the NAV goes up, that means my investment is doing well.
Exactly. And if it goes down, well, the rest. But remember, short-term fluctuations are normal. The key is to focus on the long-term growth potential of the fund.
Don't panic if you know the market has a bad day or bad week.
Exactly. It's all about the long game.
Okay, got it. NAV check.
Yeah.
Anything else I need to be aware of?
Helen emphasizes the importance of understanding the benchmark. Remember how passive funds track a specific market index? Well, benchmarks are used to compare a fund's performance against a relevant market index. This helps you see how the fund is doing relative to the overall market.
So if a fund is consistently beating its benchmark, that's a good sign.
It can be, but it's not the only factor to consider. You also need to look at the fund's risk level and expense ratio. A fund might outperform its benchmark, but if it's taking on a ton of risk to do so, it might not be suitable for your investment strategy.
Right, it's like, getting a really high score on a test, but you cheated to do it. It doesn't really count.
Exactly. It's about finding a fund that aligns with your risk tolerance and long-term goals.
So not just chasing the highest returns, but finding something that's sustainable and appropriate for my situation.
That's the idea. And speaking of long-term goals, let's talk about one of the most powerful concepts in investing, compounding.
Compounding, that sounds a little bit scary.
It's actually not scary at all. It's amazing. Think of it as a snowball effect. When you invest your money and it earns a return, that return then earns its own return. Over time, this compounding effect can create significant wealth, even from relatively small initial investments.
So the longer I keep my money invested, the more the snowball just keeps getting bigger and bigger.
Exactly. Compounding thrives on time. The earlier you start investing and the longer you stay invested, the more powerful this effect becomes.
Wow. Okay. I'm starting to see why people get so excited about compounding. It's like this magical force that just grows your money over time.
It really is magical. But remember, patience is key. Compounding isn't a get-rich-quick scheme. It's a long-term game.
Okay. No shortcuts in investing.
Not if you want to build real wealth.
All right, I'm starting to get the hang of this mutual fund world. Different types of funds, expense ratios, NAV benchmarks, and the magic of compounding. It's a lot, but it's making sense. What's next on our investment adventure?
Now that you have a good understanding of the basics, let's talk about actually building your first investment portfolio.
Okay, building a portfolio. Now we're talking lead the way. I'm ready to get started. Okay, so we've talked about all the different types of mutual funds. We've talked about, expense ratios and NAV and benchmarks and compounding and all that good stuff. But now I want to get practical. Like, let's say I'm, fresh out of college, first real paycheck hitting the bank account. Where do I even begin with building an investment portfolio?
Well, it's definitely an exciting time, right? Starting your investment journey. And the good news is you don't need to be a financial expert to get started. Helen really emphasizes the importance of starting small and building gradually.
Okay, so baby steps, right?
Exactly. And the key is to align your investments with your personal goals and your risk tolerance, because everyone's situation is different.
Right. Some people are, more comfortable with risk than others, and everyone has different financial goals.
Exactly. So it's not a one-size-fits-all approach. You need to figure out what works best for you.
So, for example, let's say my short-term goal is to, travel the world in a couple of years. Would that change my investment strategy compared to saving for retirement, which is, decades away?
Absolutely. For shorter-term goals like travel, you'd likely lean towards more conservative investments, like maybe a hybrid fund that mixes debt and equity.
Okay, so something that's not too risky because I don't want, the market to crash right before I'm ready to book my flights.
Exactly. You need that money to be relatively stable and accessible when you need it.
All right. And what about long-term goals like retirement?
For long-term goals, you have the advantage of time on your side, so you can afford to take on a little more risk and potentially earn higher returns.
So something like an equity fund would make more sense for retirement savings.
It could be, yeah. Especially if you're young and have a long time horizon, you can ride out those market fluctuations and benefit from the long-term growth potential of the stock market.
Okay, so further away the goal, the more risk I can afford to take.
That's a general principle, but again, risk tolerance is personal. Some people are just inherently more comfortable with risk than others, regardless of their time horizon.
Right? It's all about finding that sweet spot between, chasing those potential returns and sleeping soundly at night.
Exactly.
So let's get practical. If I'm a young professional just starting out, what might a simple balanced portfolio look like?
Well, Helen recommends a three-pronged approach, which I think is a great starting point for beginners.
Okay, 3 prongs. I'm listening.
So first, remember that emergency fund we talked about. That's your financial safety net. And ideally, you want to keep that in a liquid debt fund for easy access if an emergency arises.
Okay, so emergency fund comes first, safety net in place.
Exactly. Then for your short-term goals, like your travel plans, for example, you might consider a conservative hybrid fund that blends the stability of debt with some of the growth potential of equity.
Okay, so a little bit of both worlds.
Exactly. And then for the really long-term goals like retirement, that's where a diversified equity fund could really shine, maybe an index fund tracking the Sensex.
Okay, so 3 buckets: emergency fund, short-term goals, long-term goals.
Precisely. And you can adjust the allocation to each bucket based on your individual circumstances and risk tolerance.
This is making a lot more sense now. It feels like I actually have a roadmap to follow.
That's great to hear. And remember, your portfolio isn't set in stone. It's a dynamic entity that you revisit and adjust as needed.
So it's not like I make these decisions once and then just, forget about it.
Not at all. As your financial knowledge grows and your circumstances change, you can fine-tune your investment strategy accordingly.
So maybe, I get a promotion, or I buy a house, or I decide to start a family. All those things would impact my investment decisions.
Absolutely. And that's where Helen's emphasis on ongoing learning really comes in. It's about staying engaged with your finances, continually learning and adapting as you go.
Right. It's not just about setting it and forgetting it.
Exactly. Financial knowledge is empowering. The more you understand about personal finance and investing, the better equipped you'll be to make smart choices that serve your best interests. But before we get too excited about building our dream portfolios, we need to talk about risk.
Yeah, risk. That's a word that gets thrown around a lot. But what does it actually mean in terms of investing?
Well, investing risk is basically the possibility of losing money or not getting the returns you expected. And there are different types of risk we need to be aware of.
Okay, let's break down those different types of risk, because understanding that feels really important for making good decisions.
Yeah. So one type of risk is what we call market risk. And that's basically the ups and downs that happen in the market as a whole. The stock market can be volatile. Sometimes prices go up, sometimes they go down, sometimes dramatically.
So even if the individual companies I've invested in are doing well, my investments could still be affected by things like, economic slowdowns or global events.
Exactly. That's market risk in a nutshell. And then you've got inflation risk.
Inflation risk, okay.
Yeah. So even if your investments are earning a return, that return might not be enough to beat the rising prices of, everything.
So my money might be growing, but its actual purchasing power could be shrinking over time.
Right. Exactly. And then there's liquidity risk.
Liquidity risk. Okay. This is getting a little complicated.
It's not that bad. Liquidity risk is basically the risk of not being able to easily convert your investments into cash when you need it.
Oh, okay. So if I invest in something that's hard to sell quickly, like real estate, that would be liquidity risk.
Exactly. And then finally, there's credit risk.
Okay. Another one?
This one's more relevant to debt investments. It's the risk that a borrower might not be able to repay their debt.
So like if a company I've invested in goes bankrupt, I could lose my money.
Right, exactly. So understanding these different types of risk can help you make more informed investment decisions.
It's about being aware of the potential downsides as well as the potential rewards.
Exactly. And remember, higher potential returns often come with higher risk and vice versa. So it's all about finding that balance that aligns with your personal risk tolerance.
Okay. So how do we actually manage these risks? How can we protect our investments?
Well, one powerful tool is diversification, which we've talked about a bit before, but it's really important. By spreading your investments across different asset classes, sectors, and even geographies, you're reducing the impact of any single investment performing poorly.
Don't put all your eggs in one basket.
Exactly. Another strategy is aligning your investments with your time horizon. So for short-term goals, you might prioritize capital preservation and choose lower risk options like fixed deposits or liquid funds. But for long-term goals like retirement, you can afford to take on more risk with a higher equity allocation.
It's about matching your investment strategy to when you actually need the money.
Precisely. And then, of course, there's the importance of regular monitoring and rebalancing.
Rebalancing, what's that?
As markets go up and down, your portfolio might drift away from your original asset allocation. So rebalancing means periodically adjusting your portfolio. to get it back to your desired mix of investments.
So if my target is 70% equity and 30% debt, but the stock market has done really well, I might need to sell some equity and buy more debt to get back to that 70-30 ratio.
Exactly. It helps ensure you're not taking on more risk than you intended, and it keeps your portfolio aligned with your goals.
Okay, that makes sense. So let's talk about actually managing our money. I love the money box analogy, but where do I actually begin?
Well, Halan has a very clear roadmap for setting up your financial system. Remember those 3 bank accounts? Income, spend it, and invest it?
Yes.
Choose banks with good online and mobile interfaces because ease of use is important.
Absolutely. I need something user-friendly, just like a well-designed app. So where should my emergency fund go?
Fixed deposits, FDs, are a good option for your emergency fund because they offer easy access to your money. If you're comfortable with mutual funds, consider a short-term debt fund or a conservative hybrid fund. It's like having a quick access cash for those unexpected financial needs.
Okay, so quick access and relatively low risk for the emergency fund. What about the almost there and in some time sales?
For almost there, FDs or an ultra-short-term debt fund work well. For in some time, explore a mix of debt and equity mutual funds. Think of it like creating a diversified tech stack. Each component serves a specific purpose.
Makes sense. And for those long-term goals, like retirement.
For retirement, Halan recommends a mix of equity and debt, with a higher allocation to equity in the earlier years. Gradually shift towards more debt as you get closer to retirement. The key is staying invested for the long haul, riding out those market fluctuations.
Okay, so long-term investing for retirement is like building a robust system for sustained growth. What about managing risk? How do I protect my money box from potential threats?
Well, Halan identifies 3 enemies: spending without a thought, borrowing you can't pay back, and falling prey to greed. It's like those common security vulnerabilities that can compromise your entire system.
We've all been there, right? Tempted by impulse spending or lured by promises of easy money, how do we avoid those traps?
It's about having a plan, tracking your cash flow, and being mindful of your spending habits. Avoid relying on credit cards to fund your lifestyle, and pay off your bills in full each month. Credit card debt is like that technical debt that can slowly cripple your financial progress.
So true. And what about those get-rich-quick schemes? How can we spot them?
Be wary of promises of unusually high returns in a short time. It's often a sign of an unsustainable model. Think of it like those software hacks that promise to do the impossible. Do your research, understand the underlying investments, and don't be afraid to seek professional advice if you're unsure about something.
It's always better to be safe than sorry. Patience is not my strong suit,
Yeah.
It's hard to resist checking my investments all the time or getting discouraged when the market dips.
I get it. We live in a world of instant gratification, but investing is a long game. It's a marathon, not a sprint. So just remember, market fluctuations are normal. They're going to happen. And, they actually offer opportunities to buy investments at lower prices.
Okay, so it's about trusting the process and riding out those market waves.
Exactly. Now, before we wrap up, I want to touch on something that Halan cautions against in her book, and that's falling for get-rich-quick schemes or investment fads.
Oh, yeah. Those too good to be true opportunities.
Right. She uses the example of cryptocurrency, specifically Bitcoin, to illustrate this point. Her advice is to invest in things you understand and be really comfortable with the risks involved.
It's about doing your research and not getting swept up in hype.
Exactly. If it sounds too good to be true, it probably is.
Words to live by.
Well,
I feel like we've covered a lot of ground today, from managing our spending to creating a safety net, exploring all these different investment options, and understanding the importance of, risk and long-term planning. It's a lot to take in. But I feel like I have a much better grasp on personal finance now.
That's great to hear. And remember, personal finance is a journey, not a destination. Start with small steps. Be patient. Don't be afraid to seek guidance when you need it.
Absolutely. It's about taking control of our financial well-being and making choices that align with our values and goals.
Couldn't have said it better myself.
Well, that's all the time we have for today's deep dive. I want to thank you for joining us. And I hope you learned something new and maybe even feel a little more empowered to take control of your finances.
Thanks for having me.
And to all our listeners out there, we'll see you next time for another exciting deep dive into the world of knowledge.